Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the stranger restructurings I've seen recently is Carvana's recent announcement that they were going to exchange some debt for some new debt. Now, investors seem to really like what they saw. The stock, as I'm recording, is up 121% over the past month. But debt holders actually think this is probably terrible news for the company long term. So if you're a stockholder, you actually want to listen to those debt holders because they're going to tell you where the ultimate risk is for a company. I'm going to dig into exactly what happened and exactly why it may not be as good a news as you think. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the show notes. Now, one of the things that caught my eye recently is that the S&P actually lowered their rating for Carvana's debt, saying that the new restructuring was tantamount to default. So I want to get into exactly what they might be talking about here, but let's get into some of the operating details and the reason that Carvana needs to do this. This is Carvana's balance sheet. A little over $650 million in total cash and restricted cash as of the end of June 2023. They also had $1.3 billion of vehicle inventory. Now, that one is notable because one of the things you do with debt is actually buy vehicles. And the idea is that you're going to turn those vehicles over, you're going to actually turn them into more money, and then you're going to be able to use some of that money to pay down debt. But actually, inventory was down over $500 million in the first 6 months of the year. So the company does appear to be liquidating a lot of inventory. Where does all of the money go? Well, property, plant, and equipment. $3.1 billion of property, plant, and equipment, and then also have nearly $500 million in operating leases. But there's a ton of debt on this balance sheet. From a long-term perspective, $6.5 billion worth of debt, short-term revolving securities. This would often be the kind of things that you're going to use to buy vehicles. $1.2 billion worth of debt there. So in total, more than $7.5 billion worth of debt. The problem from an income statement standpoint is Carvana's not making money. Despite $3 billion worth of sales in the most recent quarter, gross profit was about $500 million, and that barely covered selling, general, and administrative expenses. So basically the operating expenses that you need to run a business like this. Didn't come anywhere near covering interest expenses, which are starting to rise because interest rates are going up. So that resulted in a loss of $105 million. If we move down to the cash flow statement, things get even worse. This is for the first 6 months of 2023. You can see that the net loss was $391 million. There was positive cash provided by operating activities of $443 million. But like I said, vehicle inventory accounted for almost all of that. Vehicle inventory was down $564 million as a result. Without that change, cash flow would have been negative for the first 6 months of the year. So Carvana is in a tough position. The business isn't making money. The balance sheet is really in a tough position. So what do? Well, you need to restructure that debt. That's one of the things that companies do when they're starting to get into trouble. And that's exactly what we saw. This is the transaction overview from July 19th. 90% of note holders, representing approximately $5.2 billion of senior notes, agreed to basically exchange those for new notes that would be due in 2028 through 2031. So the idea here is that you take debt that starts to be due in 2025 and turn it into debt that will be due later on. This might be a little bit small, but you can see this is the debt that we're talking about here. 2025 debt is due October 1st, 2025. There's $500 million worth of that debt at a 5.625% interest rate. Keep that number in mind. 2027 debt, $600 million, 5.5% interest rate. 2028 debt, $600 million again, 5.875% interest rate. And then 2029 debt, $750 million, 4.875% interest rate. So all of that debt, the highest rate is 5.875%. What are they turning that debt into? This is the section that covers what these new notes are going to look like. Tranche number one, $900 million worth of debt due December 2028. 12% payment in kind interest in year one. That means basically they're just going to issue more debt with a 12% interest rate. So if you have $1 billion worth of debt, instead of paying $120 million in interest, you just give a new note worth $121 million. You're not actually paying anything down. So by the end of this, there's going to be far more than $1 billion worth of debt just from this first tranche. In year 3, you go to a 9% cash interest payment. So we've gone from those interest rates that were under 6% to now 9% cash that's due on what will be ultimately be close to $1.2 billion worth of debt. Tranche number 2, $1.35 billion worth of debt due June 2030. This payment in kind portion is 13% interest. The second year goes to 11% cash or 13% payment in kind. And after that, 9% interest rate. Tranche number 3 is $1.7 billion worth of debt due June 2031, 14% payment in kind in years 1 and 2, and 9% after that. What this effectively is doing for Carvana is reducing the interest payments due over the next 2 years in return for a much higher interest rates in the out years. Now, I do want to note one thing here. This debt is callable, which basically just means that the company can buy back the debt. There is a premium after year 1, after year 2, and then after that, it's callable at par. Or they can pay it back at the value of what the debt is overall without paying that interest. So what is management doing here? Well, they're really kicking the can down the road. In the next couple of years, if they weren't able to refinance their debt and get new debt to keep operating, they were going to have to ultimately file for bankruptcy. That was what the market was really starting to price in. The bet right now is that by 2028, 2029, interest rates are going to decline and Carvana's business is going to improve really rapidly. So what you do is you reduce those interest payments, the cash payments over the next 2 years in the hopes that maybe in year 3 or year 4, you're actually be able to refinance at something closer to that 5%, 6% interest rate because you've now shown bondholders that you have a profitable business, that you're generating free cash flow, that you're actually going to pay them back. And then you can call those loans because I don't think at the end of the day, Carvana is going to survive as a company if they're going to have to pay 9% on the debt that they have outstanding. That is just an astronomical interest rate and is probably not sustainable for the company. So I think this is really a Hail Mary. The fact that the stock is reacting the way that it is I think really surprising because this was not a positive move. It maybe means the company will survive for the next couple of years, but we need to see those margins stay as high as they are. They were really good last quarter, but volume is down. So volume needs to pick up and operating costs need to come down. A lot needs to happen for Carvana for this to be a good investment from an equity side because bondholders are telling us they are in control. They're making the rules. And given these high rates and the increase from the rates that Carvana had gotten previously, these are not good signs for investors. So what did you think? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.